Hello everyone, and welcome to today's webinar titled Drive Higher Growth Through Metrics. My name is Rihanna Collier. I'm Vice President of the Software Division at SIIA, and I'm delighted to be joined by our presenters, Lauren Kelley, CEO of OPEXEngine, and Michael Baer, CFO of HealthWise. Before I turn it over to Lauren and Michael to dig into the content today, just want to go through a couple of housekeeping reminders and announcements. First, all phone lines are set on mute. We are recording the webinar today, and you will receive a link to the recording and presentation. We do want to answer all of your questions. So if you have questions, please enter them in the chat box on the left-hand side of your screen. We'll do our best to get to all the questions after Lauren and Michael go through the main part of their content. But feel free to ask your questions at any time throughout their presentations. We'll keep track of those and make sure they answer as many questions as possible. If they don't get to all the questions, we'll get answers from them and get back to you with answers to your questions. Next, I just want to highlight a couple of upcoming SIIA events that you might find interesting and might want to get involved in. The first one here is our Deciphering Product Development event taking place October 23rd in Plano, Texas. This event is exclusively for product development executives focusing on those product roadmap strategies. If you're interested in attending or more information, my email is there on the screen. We'd love to have your participation. There is no charge to attend for qualified product development executives. So I encourage you to maybe share it with your team if they might be interested in attending. We'd certainly welcome their participation. Next is another event in our Deciphering series, and that's Deciphering Customer XS taking place November 13th in Cambridge, Massachusetts. Again, qualified customer success executives attend for free. So if you are interested in attending or you want to pass it along to your team, I encourage you to do so. And then finally, this is very exclusive to this group we have here today. This is the first sneak preview to an announcement the SIIA is going to make on Thursday. We are launching 7 new communities within SIIA. You can see the list there on your screen. These communities are going to be focused on facilitating resource sharing and networking. So there's more to come. I just wanted to kind of let you know to be on the lookout for that announcement on Thursday, because there's some exciting new things happening at SIIA, and I hope you and your teams will find them valuable and want to get involved and leverage some of the stuff that's going on at the SIIA. So with that, I want to turn it over to Lauren Kelley, CEO of OPEXEngine. Lauren?
Thank you, Rihanna, and good morning or afternoon for those of you on the line. Thank you for joining us for this webinar on benchmarks and how to put them to use in your company. I'll be sharing some of the key learnings that we see in how companies can interpret benchmarks, which help set the stage for how to use them in your company, and what some of the 2014 benchmarks tell us about growing software and SaaS companies. And we're really lucky today to be joined by Michael Baer, CFO of HealthWise, a leading SaaS company in healthcare ERP, to hear about how he uses benchmarks in his role at HealthWise to identify areas to improve and to work effectively with the executive team. So with that said, let's look at the agenda. We'll start off today defining what benchmarks are important in the software and SaaS industries and how to look at them to get the most value from benchmarking. Then we'll share some of the latest growth and expense ratios from the 2014 benchmarking, and then I'll interview Michael on his experience in various companies. So first, let me tell you quickly about OPEXEngine so you know where I'm coming from. OPEXEngine is in its 8th year of benchmarking the software and SaaS industries, and we partner with the SIIA. We've been doing that for a number of years now. We focus on early stage up to mid-size, so roughly $400 million in revenues companies, Primarily, we work only with B2B companies and have worked with hundreds of companies over the past 8 years, many of which have IPO'd and or been acquired. Some, like Omniture right now, did both. So it's been interesting to see the different metrics that different stages of companies use. Our focus is on providing credible, clean data to operating executives as compared to most of the other data sources out there, which were developed for investors who pay a lot more, so that's a better business model for those companies. But I spent 25 years in senior executive positions, including taking a company public successfully and being an officer of a public company. So I built OPEXEngine to serve the needs of operating executives and try and help and get companies some data to make better decisions by. So let's start off talking a little bit about the metrics and how the metrics have changed over the past 10 years, really. As you all know, the software world shifted from selling perpetual licenses, which can be modeled relatively well with GAAP metrics, to selling subscription software or services. Subscription business models aren't described very well by GAAP metrics, since you pay your expenses up front, but you receive payment for your products on a monthly, quarterly, or annual basis, and you recognize your revenues ratably. So expense, cash, and revenue recognition are on different timelines. And that's not to mention that subscription businesses are all about your customer relationship. So you have metrics around your customer growth, your cost of customer acquisition, your customer retention rates, your customer upsell rates. And the SaaS model is a more slow-moving model, so it takes a longer time to get started and really build momentum. And then once you build momentum, you're going really fast. So you need to track your performance even early on in a detailed way to make sure you're on track. And then once you're going, the SaaS model can be more predictive of your results, but you want to focus then on the metrics around growth and making sure that the customer acquisition process is successful, efficient, and scalable. Again, GAAP metrics don't really help you do much to track or identify how you can improve this whole process. So we like to say the devil's in the details. The SaaS model's given rise to all sorts of new metrics around recurring revenues, customer acquisition and acquisition costs, churn, renewals, customer lifetime value. And there's a lot of information on the web and some excellent analyses of these metrics from people like David Scott's blog. But the key point to think about this is that none of these metrics are GAAP metrics, so there's no accountability for how you define them. And most companies develop their own definitions, which is appropriate, but it makes it difficult to benchmark just random bits of data that are floating out there. So be wary of data that you see floating around, since you don't usually know how they've been developed or how they relate to your business. So take, for example, cost of customer acquisition, which is variously called CAC or COCA, both of which, but make me think of unrelated things. Some definitions of CAC ignore marketing, or they parse it in a limited way, and then, that may or may not relate to what you need to spend on your cost of acquiring customers. Or the equation for calculating the lifetime value of a customer, LTV, which takes into account gross profit margin and looking at the profitability of a customer over their lifetime. So many SaaS companies have been using only the product or the recurring revenue gross margin and LTV. But over the past 2 years, and particularly last year, we have been seeing a lot more companies, particularly well-funded venture-backed SaaS companies that are really focused on, fast growth, market leadership, market and customer acquisition, using professional services, even, as a loss leader, to convince customers to purchase or to hold their hands and have them use the product and get them on board. So is that part of cost of customer acquisition, or also should you think about using the company gross margin instead of just the recurring revenue gross margin, because it more accurately reflects the value, the profitability of a customer? because it's all rolled into that. So it's something to think about. In our benchmarking, we have standard definitions for all the metrics that we track, which we're constantly evolving together with discussions with leading CFOs and CEOs and investors. And we work with each individual company to input their data into the system to ensure, as best as possible, that we have apples to apples comparisons, even if the apples are, some are red and some are green. So another key point to think about when looking at benchmarks is that benchmarks are really relative. The key point here is it can be very misleading to focus on one metric or one data point in isolation. So take, for example, cost of customer acquisition. If you hear that CAC of $50,000 is good, what does that mean? If your average contract value, ACV, is $4,000 a year and your LTV is $12,000, then a CAC of $50,000 doesn't sound so good. But if your ACV is $60,000 and your LTV is $300,000 or $500,000, then a CAC of $50,000 is pretty good. So, and this holds true for not just cost of customer acquisition, but most benchmarks, really, I would argue. Take, for example, revenue growth. You might think, well, revenue growth is one metric that you can really look at in isolation. High revenue growth is great, low revenue growth is bad. But take, for example, Demandware, which has a relatively low revenue growth rate compared to other SaaS companies. And they have one of the highest revenue to market cap multiples out there because investors are looking at a whole set of value metrics which combined and in relationship to each other are driving a high market cap for Demandware. So my final slide on just how to interpret benchmarks relates to how to decide or how to think about how the group of companies that you compare yourself to. So key point here is to think about, what's the cohort, not just in terms of revenue, not just in terms of stage and size of revenues, but also the business model. So a lot of companies want to compare themselves to their competitors, but there's a big difference between comparing your product and your market versus comparing your business model to your competitors, of which they're generally one or two giants, some startups, some mid-sized companies, not to mention those companies that really do something totally different but get in the way in the market. So you want to look at revenue size and stage because a startup will have different metrics and ratios than a much larger company. But you also want to look at the business model. So if you are selling a low-priced product, you're selling to a large market through a low-touch sales and marketing model, you're probably investing a lot in your web presence and inbound marketing systems versus if you have a high ACV with direct enterprise salespeople, read expensive salespeople with high travel budgets and high-touch enterprise customer support, your expense ratios are going to be quite different, and your ongoing cost of product and R&D will be different. You probably are investing a lot more in the back end than a low-priced product company, which would be investing a lot more in user design and ease of use. So those are some of the things that we sort our data by and we look at. So getting into some of the data, one, I think most people would know that renewals in a subscription business are one of the key metrics that you do want to track at all times. And a lot has been written about the hidden cost of churn. Churn's a really important metric to watch, and it's a relative metric. So we see in the benchmarking, so here in the chart we're showing general numbers for all of SaaS companies. Then we broke it out by venture-backed versus non-venture-backed private firms, and then also looking at public firms. And we look at both customer retention rate as well as the dollar renewal rate. But we see a number of trends, or sort of definitely we see that companies selling higher price point products, enterprise systems typically, have lower churn than companies selling a low price product because the higher price product has a long sales cycle, there's a lot of people bought into it, it's usually integrated within the enterprise, it was a central decision to some extent, whereas a low-price product typically has a short sales cycle where it was a quick purchase decision, and it's also easy to, it's easy to decide to buy, and it's easy to decide to stop using the product or switch to a competitor. So some of those kind of things are just in the nature of the product, and so even some of the biggest, very successful public companies, when we work closely with them, we see that the ones with low-price products have churn rates that would not generally be discussed as being acceptable for SaaS companies, but these are successful companies. So then let's look at some of the revenue growth rates and operating expense numbers that we saw this past year. And if you break that out by, and these are median rates, if you break that out by all private companies, so that's the whole group of companies that we benchmarked, and then break it down by revenues, the median rates are about 46 for companies beyond the early stage rate. But then we tend to see that expenses do come down a little bit. And what we did see last year, which was pretty interesting, is a significant increase in the median amount of venture money invested, and especially at the mid-size stage. So then if we look at the next slide and look at geographic differences, we tend to see a little more nuanced picture where revenue growth rates and operating income and losses for the East Coast, the Central and Mountain region, and West Coast. Generally, companies on the two coasts had the most venture money invested, and the Central and Mountain region the least. As you can see, the Central and Mountain region tended to have lower revenue growth rates, but positive operating income. The West Coast companies had a median higher revenue growth rate for both public and private companies. And this, I think, points to the fact that generally many of the companies in the Central and Mountain regions got started as professional services companies with a very specific domain expertise, and they productize their service packages and have developed really close relationships with their customers. We tend to see those companies having very high renewal rates as well, and good upsell rates. And those companies are, whether it's just the fact that they can't access the venture money or because they're profitable and they don't need the venture money, you don't see as much money invested in that region, although there are certainly some big winners and big success stories in those in the Central and Mountain region. So let's take a look specifically at some of the public companies. I like this slide because of the nice visual alignment between market revenue to market cap multiple as well as the annual revenue growth, which, as you can see, the market has been rewarding SaaS companies with very high revenue growth rates, as well as, there's a number of other value metrics that go into that valuation. And then you see occasionally outliers that maybe aren't following that, but there's other metrics there like Demandware, which I mentioned before, with not as high a revenue growth, but certainly a very high market cap. So I wanted to wrap up here and move on to talking to Michael a little bit about how he sees benchmarks and how he uses them in his company. So thank you, Michael. Can you, maybe to set the stage, can you tell us a little bit about your background? And hopefully Michael's not muted. We need to...
Can you hear me okay?
Yep, now I can
Great.
hear you.
Perfect.
That's great.
I've been, thanks for inviting me. I've been CFO of a number of technology companies spanning several industries. Most of them have been venture-backed. I took an e-commerce company public in the first wave of web companies a decade ago. I sold an optical networking company and a storage company, and I've helped a number of different companies across software, SaaS, mobile, cloud, and even clean tech with scaling through early hypergrowth into mid-sized companies. Along the way, I've also managed just about every function in the business, not just finance, but customer service and operations and BD and marketing and development. And in doing so, I've gotten a sense of how important it is to tie metrics to planning and goal setting and incentive compensation. And it really dovetails with the use of benchmarks to inform that.
That's great. It's really interesting that you have a combination of experience. I mean, you've worked with companies with all sorts of different owners, public companies, PE-backed firms, VC-backed, angel-backed. Do you see that different investors or owners look at different types of metrics?
It's interesting. I think these are all generalizations, but all owners are looking at similar metrics. But I do find that different types of investors focus more attention on different areas of the business. Again, it's always dangerous to generalize, and of course there are exceptions, but I have seen some patterns. Early stage angels are looking for signs of early stage market. So they're looking more at product progress and early signs of revenue. Venture investors tend to focus more on growth metrics. For example, revenue growth, and for SaaS companies, growth in MRR. They know their companies will consume capital investing in go-to-market and want to ensure that there's a clear return on CAC or customer acquisition cost in emerging positive LTV or lifetime customer value. And then PE investors are looking for EBITDA and, like public investors, focus on profitability. And they're also looking for predictability since less variable returns are lower risk returns. So again, while they all look at many of the same metrics, some focus on different areas.
Yeah, it's interesting. I can definitely say, working with lots of different companies, that PE investors and VCs and different types of VCs definitely are interested in, have slightly different focuses, and I hear that from the other CFOs as well. So what are some of the key metrics you've found useful to drive performance?
It's a tough question because it's a broad question.
Yeah.
Every company has its own key performance indicators, or KPIs, that are driven by the type of business, the marketplace, the owner's goals, and a lot of other factors. Metrics at an early stage growth-oriented technology company will be dominated by measures tracking product development milestones and early revenue traction. Whereas companies building revenue tractions will pay more attention to revenue growth, revenue per customer, gross profit, things like that. As they build up their history, they'll want to pay more attention to customer lifetime value and customer lifetime revenue. There's an interesting debate about which is more important, LTV or LTR. My feeling is that both matter. Long-term revenue potential helps guide you to the right business structure, but ultimately you need to generate a positive LTV. Startups need to care a lot about LTV, even though they don't have customer purchase behavior. They should have a working business model, the way they think about how their business will work in the future as they build up history. Even though it's early, these companies should start thinking about the metrics that will drive their customer profitability models later on. There's not enough data to conclude anything early on, but they'll have the data as they get started, and they'll help to correct their business model, and they'll want the history so they can look backward at the appropriate time.
Yeah. So how have you used benchmarking, when you identify the key metrics that are important to your company, and then how have you used benchmarking to evaluate where you stand in terms of those metrics?
Sure. As I mentioned, every business has its own metrics. So it's important to think about what the individual business should be doing. But it's hard to evaluate in a vacuum, and that's where benchmarks become so important. We benchmark all the time based on our histories. I think about, what should I pay a developer? How much is a reasonable rate for rent? how many sales calls can a rep do in a week? Things that I've picked up along the way, and I have assumptions, but these assumptions are usually wrong. Developer salaries move all over depending on what skills are in demand. Rents go up and down based on market conditions. New services and tools make people make salespeople more effective, and so on. So looking at benchmarks from comparable companies that are looking at that same point in time is invaluable in finding out how our company is doing relative to the rest of the world at any point in time. But benchmarks are a great place to begin a conversation, and it starts with selecting the right peer group. Having comparable companies is critical, and as you showed in the data a few minutes ago, as you look at different segments, you'll find different patterns in the data. So it's important that you're looking at similar companies facing the similar kinds of influences on their business. Now, benchmarks aren't just for pointing out areas of weakness. Sometimes it's good to know that you're doing a great job. And it's not just a feel-good, but something that can really help you operate the business. So let's take an example. I looked at my DSOs, or Days Sales Outstanding, which is a measure of accounts receivable age. So my DSO of 30 means my customers pay me on average in 30 days. Once I looked at my DSOs, they were 26. So was that good? Was it bad? Was it okay? I didn't really know, and as I said, having the right peer group is critical. So if you think about DSOs of 26 and you're a retailer, it's terrible. It turned out that my peers in the business that I was in were running at about 35 or 40 days. So we were doing pretty well, and we also had plenty of cash. So that seemed like it was good. One read of that is that we could have been more generous with credit terms and more lax on collections, but apparently after checking with the sales team, we really weren't losing any business due to credit issues. So my read was that we could spend less time on collections and dedicate that finance staff time to other things that added value in other areas. So benchmarking can tell you a lot, and in this case it told us that we were too good in an area and didn't need to try so hard in that particular focus.
Yeah, that's a great example. That's one where you had the data and you used it within your own department to manage your own department, the finance organization. Are there ways that you use the data to help affect positive change in other departments and with other executives?
Sure. I just gave you an example of a positive change, but that was one that I could sort of focus on within my own department. We were doing well, and we could back off in collections. But more recently, I benchmarked my company against its peers in the software business, and I got some real eye-openers. As an example, our revenue from services was much lower than our benchmarks. It turned out that we included a lot of services in our monthly fees. Now, knowing how our peers price has been helpful in guiding us on how we price our new offerings, to separate out some services that were included before, and also help guide us to rolling out a new services offering that we really weren't thinking about before. But you have to be careful and really understand the data. It turned out as well that our CAC was well in excess of our peers. You talked about that a few minutes ago. I had to do some digging in the benchmark data to find out that since our average contract life is so much longer than the peer group, it actually made sense that we spent more time up front in selling those customers. Since it was a very long-term agreement, it was a long selling cycle, but in reality we ended up paying less in account management over time since we had very little churn. So again, it's important to really understand the benchmarks, think about how your business is different from or the same as your peers, and then aspire to get to the levels that you're seeing in your peer group if you're missing them.
That's great. That makes a lot of sense, and those are good concrete examples. And do you find when you're talking to, when you're using benchmark data and you're working with other executives, we're all in, or most companies are currently just gearing up for the budgeting process for next year, and personally having been through many budgeting processes, which is usually not a favorite activity of the non-finance executives. if I can say that. It's something that, a lot of companies that I work with say the benchmarks are incredibly valuable for them in working with the other departments as they build the budget, as they do strategic planning. What have you found is the best way to go about that or to present it?
I couldn't agree more. I think benchmarks are critical in the planning process. I think having benchmarks is a great way to put the facts into a conversation and take the emotion out of the conversation. Without a comparison set, it's really just a conversation about a number. I said it a minute ago. DSOs are 26. Is that good? Bad? Great? Don't know. Without benchmarks, board members have 5 or 10 companies they work with and another 20 or 30 in their fund, and that's their comparison set. They just heard about another company in their portfolio that was doing X. Why aren't you doing X? But is it right to compare a licensed software business to a SaaS business? Well, sometimes yes, sometimes no. Having benchmarks takes the emotion out of the dialogue. When you can say our plan is to spend X on sales and marketing, SaaS companies of similar size and growth rates spend Y, and the top quartile spends Z, it makes for a very different conversation. You can talk about how you behave relative to a peer group and why your level of expense is appropriate. And it's not just about talking to the board. Talking to executives in the planning cycle, talking to them about their budget is easier. It's not just me walking into the sales guy to say, you spend too much on non-salary sales expenses. Or talk to the VP of engineering to say your salaries are too high. I can show them real comparative data and ask a question like, why do you think our peer companies can spend less on non-salary expense? Or why are other company salaries lower? And it changes the whole conversation. It turns it into teamwork around figuring out a problem. And if you start that conversation showing data about where we're better than peers, it's a great place to start.
Yeah, those are great examples. I'm just thinking about some of the conversations I've had recently because in the benchmarking we track revenue per employee as well as revenue per quota-bearing salesperson. And as you can imagine, for a lot of companies that's started some interesting discussions. And it's a lot easier having been on both sides. I mean, having been in sales and running sales organizations, it's a lot easier when there's numbers to talk about rather than, you just aren't making enough money per salesperson and, you're top heavy and those kind of things. As you say, it takes the emotion out of the conversation and puts them back.
And it also helps with an aspirational business model where we have a business today, we think here's where it's headed. Let's look at companies that look today like we want to look in 3 years and see what that means for a long-term plan, long-term staffing plan or mix of inside and outside salespeople or lots of other ratios. It's helpful in many regards to have a good sense of where you're headed so you know where you're going.
Yeah, and it also, it sort of tends to bring up other issues which might not have gotten brought up if it was just an emotional conversation because, if I feel attacked that I'm just not a good manager because my salespeople aren't producing enough and I'm paying them too much and I'm just not managing that well as compared to benchmarks. Or if I'm presented with neutral data and we can talk about it as a team, it might turn out that there's some reason why our product isn't selling as well. And it might not only be because the salespeople are bad, but it may also be that the salespeople have something to contribute in terms of some other need that would help sell that product. And it just helps bring up a lot more issues so that you can really get to the root of the problem. So with that being said, what are some of the process suggestions that you'd make, both in terms of collecting data as well as presenting benchmark data? That's
a great question. I would start out with saying benchmarking is a process. It's not a simple analysis that you do once and then toss it away. So you need to think of it that way. Start with the data you can get already, and then think through how to estimate the rest. There's a good reason that you at OPEXEngine ask for certain data. That's because many others are using it. And if it's not important to you, but the survey is asking for it, you should probably have a good reason why you don't think it's important, because a lot of other companies apparently do. And if it is important, or it seems to be, and you don't have that, you're not tracking that data already, it's a good prompt to figure out a way to get it. So the first time you go through the exercise, some of your data may just be guesses. But the next time through, you'll have real data, and it gets better, and it gets easier. Eventually, you'll set up dashboards so that you can watch that data either real-time or weekly or monthly or whatever, but you'll start to track it. Now, presentation is key. The information must be consumable. I've stressed the importance of selecting the right peer group. First time through, talk about the process and the peer group to get buy-in that the data is relevant. And then you're, as a finance person, you go through and you've got lots of statistics. There are lots of places where you can be better or worse than your peers. Pull out 3 to 5 key observations, the ones where you see a real opportunity to take action. If it helps, do a graph of all the possible variances. One axis is how hard the solution would be, and another is the impact on the business. Start with achievable goals with measurable impact. Either small or large. It doesn't matter. You want to show some traction. It doesn't help to pick metrics where it will be impossible or incredibly difficult to change. So show the 3 to 5 recommended changes, and that's where you can add real value as a finance professional. Show the variance, why you think the variance is there, and a potential type of action. You don't have to solve the problem, but being perceived as a partner and a problem solver can be really helpful in positioning the whole dialogue. I talked before about what I found when our services revenue percentage was lower than our peers. I highlighted that along with some other actions. My suggestion was to consider a separate services offering. I didn't know what that was or what it would look like, but it turned out that our head of services was already thinking about an economic justification for a new hire in our training department. Bang, problem solved. Not everything's going to be that easy, but by laying out the data with possible solutions, you're becoming a partner, not a policeman. Now, I'll also suggest tying in benchmarking with the rest of financial analysis. It's really one tool in your finance toolkit. I presented our company's benchmarks along with our company's first customer and business line profitability analysis. It helped us see all that new data right along with comparisons. So our whole team thought that one legacy product line was losing money. In reality, it was marginally profitable and looked better than its peers on a standalone basis. It changed the whole conversation. So if you think about what your audience is ready to hear, use benchmarks and analysis sort of sewn together in one conversation, it'll help them bridge from what they already know to what you're trying to tell them. And then really focus in on being a partner in solving a problem.
That's such a great description. I love that you identify benchmarking as a process and not just, I need some numbers for this presentation, or I need to answer this question from an investor, I need a benchmark. Boom, done with it, go on with your regular business. I can only say after doing this for 8 years that the companies who do it regularly get so much more out of it each time. We've talked about how, in the first place, the data and the definition of the metrics not only is complicated, but it's also changing. There's great analysis out there about how to, put together those metrics. And I find a lot of companies that participate in the benchmarking the first year, a lot of the numbers they're just guessing at, but by the next year they've put in process some processes to have those numbers. And because we tend to we're benchmarking from a budget perspective, so it's not just the financial metrics, but it's, across the board, hopefully we're trying to capture the levers that will have an impact on your business. And it is a process. It's a process to talk with your colleagues to get some of that data. But I think if you could sum it up, what would you see as really the key value that you've seen in benchmarking on a regular basis?
That's a hard question to say that there's one key value. I mean, it's really tough to summarize it all in one answer. I guess the biggest thing is the theme I keep coming back to. It makes conversations objective and data-driven instead of emotional. It really makes finance a partner in helping improve business operations as opposed to a policeman who's just there to count things. And it makes any conversation that much more valuable and actionable.
That's great. No, I think that definitely sums it up. Well, thank you so much, Michael, and I hope your budget process this year going forward is very quick and easy, and I'm sure you'll have a great process in place. So with that, I think we're going to move on to questions. Well, we've got one wrap-up slide. If I can leave you with any call to action or to do, I would obviously, from my own self-interest, but definitely recommend that companies benchmark. This slide is just showing a little bit about our online application where companies input their data and then they can see their own data against whatever peer group they choose and create reports out of that. But with that, maybe I'll turn it over to Rihanna as the chairperson and open it up to any questions that people have.
Great. Thank you, Lauren. Thank you, Michael. That was very interesting. We do have some questions, but I just want to remind the audience, if you do have questions, please use the chat box. That's how we'll be addressing your questions. So there is a question regarding LTV calculation. How many years of data are required to determine this metric? Either of you?
Yeah, I can answer from a high level, and then maybe Michael can answer. I mean, generally, LTV is calculated by looking at your MRR, your churn, and your gross profit rate. So, you're looking at a point in time. I don't know if you're asking at, how many years should you be in business before you really start seeing this as a valuable metric, because obviously, very early stage company, their LTV is going to be a little wobbly compared to a company that's at, momentum and has a sustainable business. I hope that captures the question. Michael, did you have any comments?
Yeah, I guess I would just come back to the same. It's a hard question to answer as a general, in generality. It's really the specifics of the business. But I think you need to consider at a minimum, what happens over a year's time, what's your churn rate, and then think hard about the type of churn that you witness. Do you see a lot of customers churn out in the first quarter, but then for the rest of that year they stay with you? If they've made it through a quarter, they're going to stick with you for a while, or do you see a lot of churn a year out when they go through their budgeting cycle again and they start to think about, how valuable is the service, should I budget line item it again? So you have to think about how indicative even 1 year of data is. In a perfect world, you have 3 to 5 years worth of historical data. I know in startups you don't have that. In a more mature business, you do. And if you're a startup, you just have to sort of guess your way into what you think the customer behavior will be like and model it out. But that's where I come back to the importance of doing it early, building your lifetime customer value model, and making some assumptions. And then when you're 2 years into the business, you can look back at your churn rate, look at the vintages, see if you see some patterns that are underneath it, to try and extrapolate. And the longer you're in business, the more data you have and the more accurate your LTV calculation becomes.
Great, thank you. We have another question. What kind of, going into 2015, what kind of performance issues and metrics do you think companies should focus on? Lauren, maybe you can address that.
Yeah, it's interesting. I mean, definitely the focus over the past couple of years has really focused on customer metrics. And clearly subscription businesses, that's what it's all about, is getting customers, keeping them happy, and keeping them paying their subscriptions, and doing that in as efficient and scalable way. So the metrics have primarily been in that area. But we're definitely seeing, and especially for enterprise software companies, when you step back and you look at the overall expenses of the business, for example, cost of product, for example, if I look at Salesforce.com, not a company to benchmark yourself against, but just an interesting example. When they went public, their cost of product, or cost of revenue, I should say, when they IPO'd in 2004 was, I think, 28% of revenue. And it's now 10 years later, it's, I don't have it right in front of me, but I think it's something like 34%. It's gone up. And part of that is that companies, and I should go back and say a lot of SaaS companies that I've seen at their IPO level, so that I can talk about specific companies because the data is out there, their cost of revenue is around 40%. So that's a big chunk of your expenses, whereas we've all been, and we all know that SaaS companies are spending a lot on sales and marketing. Some even of the public companies as much as 50 or 55% on sales and marketing. So I think in the world that we're living in, where companies, our customers, I should say, are expecting great performance, they're expecting high security, especially if, again, you're selling an enterprise application, and we're seeing more and more companies, we're seeing the growth of sales outside the United States as this, software and SaaS market grows, particularly the SaaS market. The market researchers say the SaaS market's growing at about 20% per annum. So as companies go overseas, they are setting up hosting centers around the world. They've got increased security and performance requirements. So that's a big cost. So we're definitely seeing that as something that I think companies, or from a finance perspective, hadn't thought about as much, or you don't see as much written about. But I definitely see companies focusing on that. So I think that's certainly an area. I think also looking at international markets, and then also the rise of channels. When I started the benchmarking, everybody thought you couldn't sell a SaaS product through partners. And there are many companies that have built really significant businesses on selling through partners a SaaS subscription product. So more companies have been growing. We see from the data this past year that venture-backed firms are selling at a much higher rate through partners than non-venture-backed. And I think that's just because they're seeing that as a real engine for growth.
Mm-hmm. Great, thank you. Michael, actually, I think this question is probably directed to you. How do you calculate customer acquisition costs? And then there's the second part to it is, over the past few years with the benchmarking and everything, have you changed the metrics that you look at closely? Does it change frequently, or?
So that's both good questions. As far as how I calculate CAC, I think it's been different in every company I've been at. So it really is company specific. And I also think about two different CAC numbers. There's the one that I use kind of internally for my own my own purposes, and then there's the one that fits into the OPEXEngine model. Why are they different? Well, the OPEXEngine model has to normalize across lots and lots of different companies, so it's fairly specific in defining what's in, what's out. And to have a benchmark be useful, everyone has to define it the same way. And so I do look at that in comparison to my own numbers. But on an individual business, I have to think about which of my go-to-market expenses, my selling and marketing expenses, to include and to exclude, and it's different every time. So let's take an example. Customer conferences are a great example, and companies tend to put a lot of money into them. If those customer conferences are really more about prospect engagement and customer acquisition or engaging with existing customers to upsell them or expand the offering or grow within the customer, then I'd say that's part of CAC. If they're really more about building the community, there isn't a clear tie to revenue advancement. It's more of a getting a sense of the market and getting intelligence from existing customers, feedback, and so on. Then I'd probably exclude them from CAC. And I think you have to take every single line item, every single major category of expense from sales and marketing, and think through: is it more about acquisition, or is it more about retention, or what have you? And then separate the measures that way. Now, I don't think you have to go to the individual expense detail level, but at a high level, sort of line item by line item, decide, is it in or out? And then that's how I build up my CAC number. And again, it is different in every business that I've been in. I'm sorry, I forgot your second question.
The second question was, did the metrics that you look at change on a regular basis every year, or?
I think it goes back to what I said about the different types of investors early on. I think the metrics are pretty much the same at any point in time, but the level of attention you pay to them changes significantly at different points in the company's evolution. And so it's important to think about what's important now. Optimizing CAC is not really the focus when you're trying to build revenue. Sure, you don't want to spend money foolishly, but it's all about building up revenue traction, the customer base, referenceable customers. I'll pay way more than lifetime customer value for a key customer that's going to be referenceable in the early stages. Later on in my evolution, CAC becomes much more important because I need to think about, how do I scale? How much cash am I going to consume as a business in investing in go-to-market? And so having that LTV calculation, which if it's not clear, it's long-term gross profit minus customer acquisition cost gets you your LTV. CAC becomes very important in that, and so I want to optimize for it. I have all the data that I need, or years of data, and I can start to be very quantitative about it. So again, I don't think the measures themselves change, but I do think which measures you focus attention on does change. And I'll go back to my earlier comment about how to start with the benchmarking exercise. Look, if you use the OPEXEngine data, and you fill out the survey, there's a lot of data that you probably don't have today. But it's a great path to getting yourself fit, to getting many of the metrics that you should be thinking about in place, and coming up with a mechanism so next year you do have that real live data and build up history. And so as your focus changes, as your company goes through different stages of evolution, you've been collecting the data, it's there, it's a lot easier to use.
Okay, and Lauren, a question for you. What are some of the key changes in the metrics that you saw this year from the benchmarking report compared to prior years?
Yeah, definitely I touched on before the amount of venture money gone up significantly. I think it's that money that's coming in at the $20 million stage or so, when a company has proven the model, proven the product, but then is puts on the gas. We see revenue growth rates actually going up instead of, as the revenue grows, going down, which coming out of the license world would be counterintuitive. But when you have a lot of money put in at that point, that can help you grow tremendously. I also mentioned, I'm seeing more focus on partners, and so companies looking at how much revenue they're getting through indirect channels. But also, I'm seeing a lot more and some changes in terms of, we look at, like, for example, your total expense in marketing, and then your percentage of the marketing budget spent on comp and benefits versus the programs or other expenses. And in certain business models, salaries are only maybe 30 or 40% of the total marketing budget, and the rest is programmatic, whereas in other business models, salaries would be more like 80%. Same thing with sales. We saw some changes that were kind of interesting. In certain business models, typically sales, the vast majority of the expense is comp and benefits, whereas we're seeing more investment in certain business models in expenses that support making the salespeople more efficient. So those are some of the things that we've seen changing in the past year or so.
Great. And then, Lauren, one last question as we approach the top of the hour. What are the key metrics for enterprise SaaS companies going after the upper end of the market?
Yeah, that's a great question. And I think, I've mentioned some of them, but definitely SaaS as a, and I'm assuming, when you talk about SaaS companies going after the enterprise space, the effort early on in the SaaS sort of world was for companies playing in that enterprise space was just to validate themselves that it was okay to put your enterprise apps in the cloud. And I think now it's, SaaS is here to stay. It's much more accepted. There's plenty of examples of great enterprise companies out there. And so the vendors, the enterprise SaaS companies going after that end of the market are focusing more on, clearly they have to have the operational investment both in terms of the platform and performance and security, as I mentioned, which would show up in their cost of revenue and specifically cost of product metrics. But you also see a different kind of, customer support and customer satisfaction investments than you might see in companies going after the low end of the market. So I think those are the two biggest changes that I would see for enterprise SaaS companies going after that, and also, clearly going after the international space is definitely part of the equation.
Great, thank you. Well, I want to thank Lauren and thank Michael for being with us today. I think this has been very helpful. If we didn't get to your question, Lauren and Michael will take that offline. I encourage all of you to look at the benchmarking that OPEXEngine does. The SIIA is happy to be a partner on the annual benchmarking report. And if you are a member of SIIA, you do receive a discount to participate. So I encourage you to take a look at it. As you can see, it can be extremely valuable to your business. So with that, I hope everybody has a wonderful rest of the week and enjoy the rest of your day.
Thank you, Rihanna, and thank you, Michael, and thank you to all the listeners. This has been great.